Welcome to This Explainer. Today we're unpacking a really fascinating case study that perfectly captures the booming e-commerce scene right now in Pakistan. We're going to look at this entirely through the lens of Dardanelles Bazaar Limited, or DBL for short. They're a massive e-commerce marketplace operating via a website and a mobile app. Now, local businesses use DBL to sell literally everything, from digitally ordered physical goods to digitally delivered services, reaching customers all across the country. But beneath that seamless, super easy surface of just browsing and clicking add to cart, there actually lies a hidden, incredibly complex web of digital taxation. So let's dive right into this. Have you ever actually stopped to wonder, when you click buy on a digital marketplace, who exactly calculates and withholds the tax? You might just assume it's entirely up to the seller to sort it all out at the end of the year, or maybe you think the marketplace itself just handles the whole shebang. But when money is moving digitally across all these different platforms and flowing through various intermediaries, the legal responsibility for tax deduction shifts in some very surprising ways. And it all depends on the exact nature of the transaction. Here's our roadmap for today's explainer. 1. The e-commerce tax maze. 2. Clothing sales via bank. 3. Cash on delivery. 4. Mobile wallets and services. And finally, 5. Filing and reporting. Okay, Section 1, the e-commerce tax maze, navigating digital transactions on DBL. Now, the core challenge for a marketplace like DBL is managing this huge variety of sellers, payment methods, and products. Why? Because every single one of those variables triggers a completely different set of tax laws. Moving to Section 2, clothing sales via bank, debit, and credit card transactions. Picture this. You've got a Lahore-based clothing manufacturer selling a bunch of apparel to customers way down in Karachi. The customers pay digitally using their debit or credit cards, and the whole transaction is processed through a local bank's payment gateway. Once it clears, the net proceeds hit the seller's bank account. So what we have here is a physical good combined with a digital bank payment. Now let's look at the tax breakdown for this. For income tax, you're looking at a 1% rate under the final tax regime, which just means that 1% is the final word on income tax for this specific transaction. Sales tax is a 2% withholding, but check out the treatment here. It's adjustable. That means it's not a closed book. The seller can actually reconcile this amount against their overall sales tax liability later on down the line. But here is the big twist. Who's actually collecting this money for the government? It's not the clothing manufacturer, and it's definitely not DBL. It's actually the local bank. Acting as the payment intermediary, the bank is the designated withholding agent. So at the exact moment they process your payment, the bank is legally responsible for withholding both that 1% income tax and the 2% sales tax before they pass the remaining funds on to the seller. The bank is quite literally doing the tax collection right in the middle of that digital handshake. All right, Section 3. Cash on delivery, cottage industry sales. Cash on delivery, or COD, as we all know it, is a massively popular payment method in Pakistan, right? And honestly, it changes the tax mechanics entirely. In this scenario, we have a cottage industry selling handmade products on DBL. But instead of a digital payment, a courier company delivers the goods and physically collects the cash right at the buyer's doorstep, before later transferring the net proceeds to the seller's bank account. This physical cash method completely changes the math. Your income tax jumps up to 2%. Sales tax stays at 2%, but look at the treatment this time. It is a final discharge of tax liability. Unlike that bank transaction where the 2% could be reconciled later, this is a final, settled amount. The book is completely closed. So who is the withholding agent when physical cash is being handed over at the front door? Believe it or not, it's the courier company, because they are the ones providing the courier services and physically collecting the cash from the buyer under those COD terms. The law places the responsibility squarely on their shoulders. The courier company must deduct both the 2% income tax and the 2% sales tax before they wire the final proceeds over to the cottage industry seller. Crazy, right? Moving along to Section 4, mobile wallets and services, digitally delivered expertise. Up until now, we've really only talked about physical goods. But what happens when the product itself is completely digital? Let's say a Karachi-based graphic design company provides digitally delivered logo services to a client in Islamabad. And the customers pay using local mobile wallets like JazzCash or EasyPaisa that are integrated right into DBL. So now we're looking at digital services paid for via digital wallets. When we check out the tax table for this kind of transaction, things look pretty different. The income tax is set at 1% under the final tax regime, which nicely matches our first scenario. However, take a look at the sales tax row.
It literally just says NA. Federal sales tax is not applicable here.
So, the absolutely crucial point here is understanding why there's no federal sales tax. It all boils down to the fundamental difference between goods and services. Our previous scenarios involved the supply of physical goods, like apparel and handmade crafts. Graphic design, on the other hand, is the provision of a service. Under the Federal Sales Tax Act of 1990, federal sales tax just doesn't apply to this transaction because it relates to providing services rather than supplying goods. Because federal sales tax is totally out of the picture here, the withholding responsibility is super streamlined. The mobile wallet company acts as the payment intermediary in this case. Therefore, at the exact time they process the payment, the mobile wallet company is legally responsible for withholding the income tax and only the income tax.
Finally, Section 5, Filing and Reporting Requirements. Where does the data go? We've seen how banks, couriers, and mobile wallets are all essentially acting as these invisible tax collectors. But how does the government actually keep track of it all? Well, the law requires some incredibly strict reporting. The withholding agents, so the bank, the courier, or the mobile wallet, they all must file a withholding statement on a quarterly basis. However, DBL, the marketplace itself, they're kept on a much tighter leash. They are legally obligated to file a transaction statement monthly. All of this comes together to create a really robust web of compliance data.
And that brings us to the end of this breakdown. We've seen how a single marketplace can trigger completely different tax treatments and utilize completely different withholding agents, literally just by changing the product type or the payment gateway. It really makes you think, doesn't it? The next time you buy a physical product or a digital service online, maybe ask yourself, how automated are your own tax liabilities in today's digital-first economy? Who is acting as the invisible intermediary in your daily transactions? Thank you so much for joining me for this explainer, and definitely keep questioning the mechanics behind your everyday digital world.